Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make a little money. My job is not just to entertain you, but to teach you. So call me at 1-800-743-CBC. Tweet me, Jim Cramer. For years and years, everyone presumed we'd have a rally during Thanksgiving week, and they were pretty much right to presume it. You knew the sellers were going to take a vacation, hold off on selling until the market went higher. You knew that Wednesday before Turkey Day would be blessed with buyers, and Friday after Thanksgiving, no serious professional would ever think of selling. But now on the eve of the holiday week, everything's changed. The machines have taken over. They take the cue from all sorts of metrics and gauges that we humans would never be able to figure out. And they're happy to sell at any time. Nothing matters except money to these machines. They don't even know about the holiday. Maybe that's how it should be. Oh, we saw a strange day today, a quick rally, a fizzle, and then a burst upward. More on that later. With the Dow gaining 493 points, S&P climbing 0.98%, NASDAQ advancing 0.88%. But what you need to know is that we can't count on the sellers taking some time off to enjoy Thanksgiving with their families anymore. That was, I guess, a very quaint time indeed. Every data point, every bit of research and earnings will be scrutinized starting Monday, just like a regular week, even as we'll be eating turkey and then relaxing with everyone watching the Philadelphia Eagles play the Bears at home on Amazon Black Friday. So it all starts with a pretty quiet Monday. At least it should be. We're going to hear from Zoom Communications. Yeah, Zoom. And all I can say about it is while I love it with my, my PC comes loaded with this Teams thing. You probably have it too. It's the bane of Zoom's existence. I was always hoping that Zoom would become more than just Zoom. Like it would buy some company to complement its video conferencing business, but it hasn't happened yet. Perhaps we'll see something next week that will change that. Otherwise, though, I expect a decent quarter and then the adjacent talk about some company potentially buying Zoom. Tuesday's real important, kind of surprisingly so, especially in a world with a dearth of hard facts to make decisions because of the lamentable, ridiculous government shutdown. First, we've got the delayed September retail sales report, and after hearing from a lot of retailers, I'm telling you, that's just rearview mirror. I'm getting the sense that we're not going to see a lot of robust numbers going forward. And that works for me, though, because why? We need to see rate cuts. As we saw today when the odds went up on a cut because John Williams, president of the New York Fed, suggested he was on board with lowering rates, and the market exploded higher. If retail sales are weak, then bond prices will go up and yields will go down unless the simultaneously announced producer price index shows a spike, which would indicate higher inflation. That could happen with the tariffs, but we can't truly be sure. Maybe it'll help when we see some pending home sales data at 10 a.m., which we know is going to be dreadful. Housing is the bane of this economy's existence because housing turnover drives sales and profits for so many different industries, and there's just not that much turnover right now. Actually, well, it's the lowest in 40 years. I think we'll get what we want, which is weak pending home sales, and that makes it easier for the Fed to cut rates in December. Maybe it's the excuse they need. Beyond that, we have a slew of important earnings on Tuesday from a host of industries. In the morning, for example, we get results from Kohl's, Best Buy, and Dick's Sporting Goods. What am I hearing? That Kohl's won't be terrible? It's probably good, though. Best Buy will be okay, probably hurt by higher interest rates and tariffs, although that should be offset by a PC refresh cycle. And the Dick's could be insanely good because it bought Foot Locker low, and now it's the right Nikes to go with the New Balance, the Hoka, and the On. That's the right lineup. Analog Devices reports, too, and I've been worried about this one because it's all about the Internet of Things, industrial semiconductors, which have been very, very weak. I believe it's not worth buying, but if the quarter's good, get this. I'd like you to buy, well, at least think about buying the stock of Texas Instruments, which is an analog to Analog. I can't believe how important Tuesday evening is. First, we have Dell Technologies. The betting line here is that the company's going to stumble because of some raw ingredients, mainly semiconductors. They've gone up so much in price during the quarter. I'm not buying it. This is Dell, for heaven's sake. I'm not worried about Michael Dell and other commodities. I mean, give me a break. He'll source them right and get them at good prices. I think the story will be about the company still doing terrifically when it comes to the data center and the enterprise. So you need to own the stock ahead of the quarter. That's a gutsy prediction, probably the most gutsy that you're going to hear tonight. I would definitely not trade HP the same way. I think HP is genuinely hostage to commodity prices, and it won't be able to make the numbers. Even though it went up almost 6% today, the stock's so low, it might not matter, but that's not really a compelling reason to buy, is it? You want a stock that is worth buying? I know that cybersecurity has been a dog of late, but when Zscaler reports, I bet records will be broken and you can break out the champagne. Why not? You've been able to do that pretty much every time it reports. It should help that the whole group, which has been falling of late, offers you some actual value for the first time. Plenty of apparel on Tuesday. Abercrombie and Fitch reports in the AM. That's a total crapshoot. It's not for the squeamish. Call me squeamish. Burlington Stores reports as part of the big three of off-price, including TJX and Ross stores. It probably hurts Burlington that the other two reported already, and they were terrific. As my mother always said, comparisons are odious. But Burlington is the weakest of the three. Finally, on Wednesday, we have John Deere with a stock that seems like it's made of Teflon. Farming is a tough and necessary business, so our government has historically been willing to subsidize them through difficult times. No farmer wants a bad harvest, but if it's bad enough, they'll get a benefit from the government, and that money often ends up being spent on farm equipment, meaning Deere. Many commodity prices have plummeted in the last few weeks. I want to know the impact of sales. Let's do this. I believe that you'll be able to buy shares in Deere after the quarter without missing too much of the upside, but there's no reason to jump the gun. As for the rest of the week, well, let's say the bottom line is I wish you a very happy Thanksgiving, and please take a break from this crazy market to enjoy some friends and some family. I'm even thinking of doing it. Okay, let's go to Rick in Oklahoma, please. Rick.
Thanks, Jim. What's your opinion of Palantir Technology?
All right, I'm a buyer of Palantir. I know it's come off, but it's a wild trader. This is Alex Karp. He's not a close friend of mine, but I think he knows what he's doing. Let's go to Ann in Indiana. Ann.
Hey, Jim. Thanks for the gift of your book. Started reading it from the library and had to break down and buy a copy.
Oh, that's terrific. I hope you like this stuff. I mean, a lot of it's like why a stock goes up or down. I've never read a book that told you that, so I tried it. How can I help you, Ann? And thank you for this kind words.
Yeah. Goldman Sachs, why are they buying Excel Sports Management? They sound like a private equity company.
You know, I wasn't crazy about that. It's funny you mentioned that because someone asked me about it the other day. They said, why are they buying? I said, you know what? I got to tell you, it didn't make a lot of sense to me. The stock reversed horribly today. It was up really nice at one point. There's a big position for my Child Trust, and then just came down hard. I hope it's nothing to do with that. Ann, you and I we're plain thinkers. And Goldman shouldn't do something that isn't exactly what is right in their sweet spot. And this one isn't. Jim in Massachusetts. Jim.
Hi, Jim. Nice to talk with you.
Same.
My question is about Costco, and I want to know why a company that seems to be executing so well has such a lackluster stock performance over the last
Okay, well, first of all, let's remember long-term it's been one of the greatest performers of all time. Second, what happens is at 44 times earnings, the rest of the market sells at a much cheaper price. Periodically, it has these fits, but Walmart's now at 40. I think that what you want to do is buy some here, as we've been telling people for the I've got to tell you, I've been saying for the club that under this price, geez, it's just, I know it's never cheap, but you know what? It is cheaper. I say Costco under 900 is a don't presume we'll have a rally next week. It's not like the old days. Just enjoy Thanksgiving. Hey, I got an idea. Try not to look at your portfolio too often. Or maybe tonight, in the face of volatility, I like to turn to some high-quality dividend stocks to wait out the storm. You're going to love this piece. I'm revealing the names. I'm watching here. Then cosmetics company Oddity. It's a bit of an oddity. One of the positive stories out of this tumultuous week. I'm running through what's working. And AstraZeneca is making a $2 billion investment to expand its footprint in Maryland, putting a couple thousand people to work. I'm hearing all about the company's latest investment in America from what is a red-hot drug company, one of the best, and we're going to talk to the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Even though stocks came roaring back today, thanks to some dovish comments from the president of the New York Fed, it was still a pretty rocky week for stocks. And when times get tough, you always have the option of camping out in the relative safety of high-quality dividend stocks. Now, these days, as I write in How to Make Money in Any Market, growth is your best defense in any environment. But I'll never fault anyone for wanting some dividend protection, especially when the market's looking shaky and short-term interest rates might be coming down. So tonight I want to highlight not one, not two, but three excellent companies with yields north of 5% that have kind of been brought down by some of the sell-off. I want to start with one that has long been my favorite. It's called Enbridge. It's a Canadian pipeline company with a sprawling network of pipes for crude oil and natural gas across North America, along with storage infrastructure, natural gas utilities, even some renewable energy assets. Enbridge transports amazing about 30, no one knows these guys, but they transport 30% of the crude oil produced in North America, along with nearly 20% of the natural gas that's consumed in the United States. Best of all, the stock sports a dividend yield of just over 5.6%. Now, you haven't had me. I'm not talking much about these energy stocks lately, but I don't know if you noticed that. But that's because we have a drill, baby, drill White House, and that generally leads to lower oil and gas prices. Although nat gas has spiked recently after spending most of the year trending lower, but oil is clearly coming down. That said, Enbridge is not like the producers. The pipeline operators are basically toll roads for energy. They're much less levered to the price of the underlying commodities and more levered to volumes. So if we produce more oil, which we are doing, that is great for Enbridge and its compadres. Plus, this is an incredibly predictable business with a deep-pocketed customer base. The only real worry for pipeline operators is government regulation. But with Trump in the White House, that's not something we need to care all about, is it? There's a reason Enbridge has given you a total return of almost 20% year to date. Given the nearly 6% yield and the resilient business model, I think this one gives you a ton of downside protection. At the same time, though, Enbridge also has a terrific long-term growth story. Our country is desperate to produce more electricity to fuel the data center boom. And when you hear a lot about new nuclear plants, well, those can take over a decade to build. Natural gas plants, on the other hand, go up much faster. And, well, look, we're sitting on almost endless amounts of nat gas here in America. Doesn't hurt that we have all these natural gas export terminals being built. They all need pipeline access, too. Plus, I had Enbridge on my mind this week after the company was flagged in a great article by RBN Energy. That's Rusty Brazil's firm. He's our go-to source for the entire industry. RBN put up this fantastic piece highlighting how Enbridge is in the early stages of a major pipeline expansion effort, which will help transport more crude oil from Canada and the Midwest down to the Gulf of Mexico. Sounds good to me, as does the entire Enbridge story. Frankly, which makes this one of my top choices for anyone who wants some yield. When you put up more pipe, you can get a better distribution, and the distribution is high anyway. All right, next up, controversial. It's Pfizer. It's the big pharma titan, 6.9% yield. Now, I got to tell you, these days I see Pfizer as basically a bond equivalent. The days of the COVID era dominance, they're long gone. While the stock finally found a bottom in the low 20s earlier this year, it's been pretty much stuck in the mid-20s for months. In other words, it hasn't given you much in the way of share price appreciation, hence its controversial nature. But since it yields nearly 7%, you can still get a decent return, even if the stock does nothing, although I obviously want it to do something. Still, if you're worried about volatility and maybe another big sell-off in the market, is a bond market equivalent really that bad? At the same time, I think that Pfizer has the ability to use some of the businesses it's acquired in recent years to build up a powerful pipeline, one that's bountiful enough to offset the wave of patent expirations that everybody seems to be so worried about when it comes to Pfizer. Pfizer uses COVID cash to acquire Seagen, that's a cancer specialist, and Nurtec, which is a revolutionary migraine treatment that they picked up from Biohaven Pharmaceuticals. Most recently, the company paid about $7 billion plus some milestone payment down to buy this company called Metsera. And that's working on one of these GLP-1 weight loss drugs. That market's so huge that there's plenty of room for many different drugs, even as we know that Lilly is the dominant company. Of course, pulling all this off is going to be a tall order. Many are betting that Pfizer can't do it, which is why the stock sells for less than eight times earnings and that near 7% yield. But I think they can easily cover the dividend with their $15 billion in free cash flow. And longer term, Pfizer has enough shots on goal that it can get through this tricky period and come out the other side as growth business, as it gets more growth. Now, it's controversial only because it's done nothing, I think. And I think it can be near a breakout. Finally, we've got a real estate investment trust, Realty Income, letter O, with its 5.7% yield. These guys own a portfolio of roughly 15,500 commercial properties that are mostly leased to retail or industrial clients. Of course, Realty Income is best known for paying its dividend monthly rather than quarterly. By the way, they've also raised that dividend 4 separate times this year alone. Now, the stock hasn't exactly been on fire lately. It's up just over 6% for the year, though the total return is closer to 12%, not far behind the S&P 500. Realty Income pulled back after its latest quarter, in part because the company managed a slight beat for the period, but merely tightened its full-year outlook rather than raising it. There's also some concern about a few of their tenants like Walgreens, which plans to close a ton of stores over the next few years. Look, when Wall Street started worrying about corporate credit last month, some investors just dumped Realty Income because they were worried about its tenant base. But you know what? I'm more sanguine. First, Realty Income's occupancy rate stood at 98.7% at the end of the third quarter, and the company had a rent recapture rate of 103.5% across almost 300 leases signed in the quarter. This is clearly not a landlord struggling to find paying tenants. Plus, most of their tenants are grocery stores or convenience stores or dollar stores or home improvement stores. All right, you can quibble about the home improvement business. Did you see Home Depot was up $10 today, though? But the other three groups sell necessities. They'll do just fine, even in an economy where many consumers are struggling. And look, no single tenant accounts for more than 3.3% of Realty Income's rent base. So even if they lose a couple, it's not a big deal. Even during the global financial crisis, their annual occupancy rate never dipped below 96.6%. If that's the worst case scenario, I'd say, well, we've got nothing to worry about here. This is a sleep at night stock that pays you a nearly 6% yield in monthly installments. I think the stock's recent pullback is, yes, a buying opportunity. Here's the bottom line. If you're looking for some yield protection in this newly volatile market, I like Enbridge, I like Pfizer, and I like letter O, Realty Income. There are a lot of high yielders that are dangerous. Their yields soar because investors don't believe the company can keep covering the cost of the dividend. But these three are not like that, and I regard them as very, very safe. Mad Money is back into the ground.
Coming up, is beauty in the eye of the stockholder? Cramer's digging into cosmetics player Oddity. See if now's the time to get into the company after days of big gains. Next.
Earlier this week, a beaten down direct-to-consumer cosmetic stock, Oddity Tech, reported a great quarter, and the stock shot up 21% at its highs yesterday. For the entire market, of course, rolled over and gave back those gains, and only finished up just 6.5%. Today, it got hit for another 4.7%. And at this point, I think you're almost getting that terrific quarter for free. I think this is one of those babies that got thrown out with the proverbial bathwater, and right now, it's a compelling buying opportunity. Of course, to be fair, I don't have the best track record in this stock. Back in the beginning of May, the company reported a fantastic beat and raise quarter and caused the stock to soar. I told you not to chase, but that it was buying on a pullback. After that, the stock kept running for the next few months, and it eventually gave back all the gains from its springtime breakout. I was right to say you shouldn't chase it, but even when we got to the pullback, I told you to wait for it to it just kept going lower. So you could argue I have not called it right. But now some of that is because of peculiar things that occurred. For instance, the co-founder and CEO, Oren Holtzman, he sold a huge chunk of stock in May, 5.5 million shares in a block trade worth over $350 million. I didn't see that coming. That didn't set off any red flags at the end, but you never want to see big insider selling, especially of that size. Then in June, Oddity did this gigantic bond offering, raising $525 million. Now, there's nothing inherently wrong with going to the bond market to raise money. However, one of the reasons I initially liked Oddity is that it had a pristine balance sheet, zero debt. That's no longer the case, and it's what initially knocked the stock off its highs. Then when Oddity reported in early August, the stock immediately fell 22%. Even though the company posted another beat and raise set of numbers, the stock got hammered because it had run up going into the earnings. There was actually very little that was wrong with it. It's just that investors had come to expect another gargantuan earnings beat, and when we got a smaller beat instead, well, a lot of people just headed for the hills. Sell. From that post-earnings sell-off in August through Wednesday, Oddity just kept getting blasted. 2 days ago, it was less than $1 away from its 52-week low. It felt like Oddity had been written off and left for dead. Even though the company kept putting up great numbers, the stock just couldn't find its footing. But you know what? That all changed yesterday. When Oddity reported on Wednesday night, the company delivered a healthy revenue beat, 24% year over year to just under $148 million, beating the $145.5 million that Wall Street was looking for. Their gross margins, this is really important, shot up 170 basis points to 71.6%. Cosmetics, very hard to have that big a gross margin. Analysts are only looking for 68.1%. And they posted a 4-cent earnings beat off a 36-cent basis. That's 25% earnings growth year over year. Very strong. What's driving this strength? Okay, Oddity's original two brands, Il Makiage and Spoiled Child, both grew double digits. Il Makiage is doing very well with international sales. The company has launched the brand in more and more foreign markets. Management believes that Il Makiage can reach $1 billion in sales by 2028. Keep in mind, Oddity is only a $2 billion company. Now, we got less detail on Spoiled Child. Curious name. But management now expects this brand to cross $225 million in revenue this year, and they sounded pretty confident about what they've got lined up for next year. But you know what? The big news here, and what really attracted me to it and why I wanted to do this piece, is that Oddity's launching its third brand. The company actually announced this on Tuesday, the day before the earnings report, and it's called Methodic, but it's spelled Method IQ. Apparently, this is more than just a cosmetics and skincare brand. Methodic is meant to be a medical telehealth platform, delivering customized, high-efficacy skincare treatments after an online diagnosis. No doctors required. With Oddity's direct-to-consumer model, you don't need to go to a drugstore either. Management says that Methodic's addressing a major unmet need in dermatology. Nearly 50 million Americans have acne, 30 million have eczema, and 30 million have hyperpigmentation. If you want it gone, you can either try what I think are somewhat ineffective over-the-counter medications, or you go to the doctor, which I regard as a pain in the butt, and possibly expensive depending on your insurance. How is Methodic different? According to Oddity, their tech integrates AI-powered skin analysis, computer vision-based progress tracking, and what management describes as, and I'm going to quote here, high-efficacy prescription and non-prescription treatments, end quote. On the conference call Wednesday night, CEO Oren Holtzman said that Methodic was testing an, quote, unprecedented scale of over 20,000 real user trials, end quote. He added that while they're starting in dermatology, the long-term goal is to expand this technology into all sorts of diseases. Oddity spent a fortune developing this platform, which may be why they needed to raise money earlier this year. I was kind of sympathetic to that. Beyond this new brand, Oddity also raised its full-year forecast on Wednesday night, with every major line coming in above expectations. Their guidance for the fourth quarter, some thought it was mixed. Their revenue outlook was terrific, but their earnings guide came in a tad light. Still, between the strength of the reported quarter, the raised full-year forecast, and the excitement about this Methodic launch, stock caught fire. Instantly soaring in after-hours trading, was up over 25% at its highs. Yesterday, the stock opened up nearly 15%, and its highs yesterday, although it was up 21%. Whew. Eventually, though, the broader market reversed and took Oddity down with it. So the stock finished the day up just 6.5%. And then today, the stock pulled back some more. To me, this seems like the real opportunity here. This spring, I told you that I really liked the Oddity story, but I told you not to chase it, right? Now, the story's the same. In fact, I'd argue it's much better with a series of beat and raise quarters, coupled with this new telehealth brand on the way that really I found very intriguing. And this time, you're doing the opposite of chasing. You're buying into weakness. In May, I said the stock was expensive, around 30 times earnings. Well, it's now selling for less than 18 times this year, or just 17 times, really. That's 17 times next year's numbers. I regard that as cheap. In fact, I'd even go so far as to say that next year's estimates look pretty low to me, implying just 4% year-over-year earnings growth. Here's the bottom line. And now, I have liked this Oddity tech for a long time. I haven't gotten it right. But the stock's big rally earlier this year turned out to be a false start. The good news, though, the fundamentals remain incredible, and the stock's a heck of a lot cheaper than it was 6 or 7 months ago. At these levels, I think it represents a very compelling value. Doug in Florida. Doug.
Hi, Jim Cramer, longtime viewer.
Excellent.
I wanted to get your current opinion on e.l.f. Beauty Supply.
Okay, someone asked me about this last night, and they said, what do you think? I'm out there talking to a lot of people, and I said, you know what, this one's gotten too hard for me. Look, I know I like Tarangin. I backed him the whole way, but it's just become one of those stocks that's like a tariff problem, and the short interest is really big. And right now, I think it's slow, but I'm afraid literally that I will get my head blown off if I say this is the level to buy it. Hey, let's stick with Florida. Let's go to Chris in Florida. Chris.
Hey, Jimbo, booyah. How you doing tonight?
I am doing well, Chief. How about you?
Good, very good. Long-time listener, first-time caller. Thanks for all you do.
Can't beat that.
My question is about the trade desk. I have a small position. Want to know if I should buy more, hold, or sell. What do you think?
Oh, my God. This is Jeff Green. And, this is maybe one of the top, the worst 5 stocks in the S&P 500 this year. But you know what? Amazon's in there. I'm not going against Amazon. They're like flailing. I don't want to go against them. I really think Jeff's great, but it's just you can't go against the hyperscalers, particularly Amazon, which actually is the largest position we have in my Chapel Trust, even as I think that at times we clash head to head. Oddity's fundamentals remain incredible. I think at these levels it represents compelling value. Much more mad money, including my exclusive with AstraZeneca, doubling down on investments in America. I'm hearing why this decision makes sense for the UK's drug makers, bottom line, with the CEO, and it could make sense for you. Then how do you spot a bottom in the market? I'm going to give you my strategy. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round, so stay with Cramer. Data centers aren't the only things that companies are spending billions of dollars to build in the United States. With President Trump threatening steep tariffs on pharmaceutical imports, the drug makers have announced a ton of manufacturing and R&D commitments in this country. Take AstraZeneca. That's the Anglo-Swedish pharma giant. In July, AstraZeneca committed to spending $50 billion on U.S. production and R&D by 2030. And today, as part of that commitment, the company unveiled a $2 billion investment in Maryland to expand an existing biologics manufacturing facility and build a new state-of-the-art facility for the development and supply of new molecules to be used in clinical trials. Earlier, we had a chance to speak with Sir Pascal Soria. He is the longtime CEO of AstraZeneca about today's news. Check it out. Welcome, Mr. Soria.
How are you, Jim? Good to see you again.
I am fine, and I'd like to know right now, where are you? Because it looks like you're on a construction site.
Yes, exactly. I'm in Frederick. We are just announcing a $2 billion investment in Maryland. And the big part of it will come to here, Frederick, where we're building a new biologics manufacturing site. And you see here behind me the photo space of this new building. It's a tremendous investment, and we're all very excited about it. The second part of the $2 billion will go to a new state-of-the-art clinical manufacturing unit in Gettysburg, Maryland, too.
Now, one of the things that I know we're all proud of is when we build these great factories, they produce a huge number of jobs. How many people do you think will get employment as you build this facility?
About 2,600 people will get a job. Some of them will be highly skilled scientists and technicians, engineers in the factory, and also construction workers. So quite a lot of jobs created over the next 5 years during the construction period.
Now,
and importantly...
I'm sorry. Go ahead. I'm sorry.
Yes, sorry. No, I was just going to say, importantly, this is the fourth announcement we make over the last 6 months. In Virginia, in Coppell, Texas. Also, we are building a cell therapy plant in Maryland. So, it's part of a $50 billion commitment that we have announced we will invest in the U.S. over the next 5 years in R&D and in manufacturing.
Now, that $15 billion commitment, which is just huge, also comes with what I regard as being a good deal for your shareholders, too, involving a deal that's made by our president, correct?
Absolutely. And as you probably noticed, our share price over the last year or so has been up 15%. Last time I talked to you was just after the ASCO, the American Society of Clinical Oncology in Chicago, where we were on the high because we had announced very great oncology results. So thank you for picking us, and thank you for being so insightful, recommending us about a year ago.
Well, sir, I have to tell you, I've always felt that your stock is undervalued because you have one of the best cancer portfolios, maybe the best, and under you pivoted dramatically toward that and going to your strengths. Not, I'd say, making it so that you're in a whole million different baskets. Tell us exactly what your breast cancer portfolio is doing right now, because it does seem like it's maybe among the best, if not the best.
Yeah, we have a tremendous portfolio in breast cancer. So recently at the ESMO, the European Society of Medical Oncology, we presented new data for our products in HER2. In HER2 positive or HER2 low breast cancer, which is a substantial proportion of breast cancer patients. Tremendous data in early treatment. Also, we announced results of that way for what is called triple negative breast cancer, which is a terrible disease affecting typically young women, and there's not a lot of great treatment for this disease, and patients pass away very quickly, unfortunately. So really tremendous results, and we demonstrated overall survival benefit. And we continue building. We have products in clinical development. So we believe that we are going to really make a big impact in breast cancer over the next few years.
I hope people realize that you're taking on the tough cancers. A lot of people feel like when you hear that someone dies very quickly, it's almost impossible to do the kind of test that is necessary. But your company's put a lot of money at risk to do that, and it has worked out for obviously for the patients, but for shareholders. It's something that most of the drug companies won't do.
Yeah, this is a great point, actually, Jim, and that's something that people often actually underestimate. There's the cost of development in our industry, but also the risk associated. I can tell you we meet as a team twice a month reviewing our new projects, and very often, most of the time, actually, I sign checks for several $100 million. The other day, for a new program in breast cancer, I signed for 2 studies, phase 3 studies, so a total of $1 billion. And if that fails, of course, it's $1 billion wasted money. So the risk associated with the work we do is very high. But thankfully, we have been very successful. We've had a success rate in the last maybe year, 2 years of about 80-90%. So it's been really very successful. And of course, shareholders have appreciated.
Well, definitely. I mean, actually, for a lot of drug companies, it's been the exact opposite. They have a failure rate of 80%. So this is rather amazing. Now, I want to talk about the most favored nation agreement you reached with the president and why it will actually benefit shareholders, because a lot of people would say, wait a second, if they have to cut price, they're not going to do well. But it looks to me like a pretty good deal for everybody.
Yeah, absolutely. I mean, I think we have been able to address the president's goals. And I say goals because I believe he had really 2 goals. The number 1 goal, of course, was to reduce the cost of medicines for American patients. But his number 2 goal was to not destroy the industry. America has a leading position in the world in biopharmaceuticals innovation, and it's really important to maintain that lead that the country has globally. So the challenge for everybody in the industry was, how do you reduce prices of pharmaceuticals, but at the same time do not destroy the industry in the process of doing it? And the answer to this was what the president calls equalization or rebalancing. So patients in the US can pay less, but patients in other wealthy countries pay more because there has been a disconnect of prices developing over the last 15 years between the US and Europe mostly. So this rebalancing will enable us to achieve those goals. And I think again, shareholders have appreciated the fact that, of course, it will bring a little bit of pain to our financials in the near term, but we can definitely absorb this. But at the same time, provide visibility and certainty over the horizon. And we can now refocus on what we do well, which is innovating for patients.
Well, it's clear that what you're doing is working because the stock has been among the best that I follow. The last question, you will be changing your listing status soon in February. What do you think that will do for your visibility in our country?
Yes, absolutely. You know, we have a goal to achieve, to reach $80 billion revenue by 2030, half of it coming from the United States, 50%. So we're very much a U.S. company. We have 25,000 colleagues in the U.S. We have 2 large R&D centers, 16 manufacturing sites, more to come, $50 billion commitment in investment. And we wanted to make sure that American investors, large and small and medium-sized, could buy our shares. ADRs are, of course, an option, but they're not a very convenient option for many investors. So we are now listing our shares on the New York Stock Exchange to enable shareholders in the U.S. to actually buy our shares and benefit from the growth this company can deliver in the future. Because we're not only investing in oncology, we're investing in cardiometabolic. Just received phase 3 results of a new drug for hypertension. Fantastic results in patients who have hypertension. They are on 3 drugs, not controlled. So as you can see, we're investing across a variety of disease areas.
Well, look, we're thrilled that you will be changing the listing. I look forward to interviewing you in February when you do that. And congratulations on your incredible success since I've seen you last. It's really rather remarkable. Great job, sir. Really, really great job.
Thank you, Jim. Thank you so much.
That's Sir Pascal Soriot. He's AstraZeneca CEO, and this has been one of the best performing stocks of this era. They have money's back yet.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
Before we get to your calls, guess what? Christmas came early. There's a special offering happening right now to join the CNBC Investing Club. You'll get my top takeaways and every charitable trust move. Scan the QR code or go to cnbc.com/Cramer Club. And now it is time to start for the light round. Christmas events. Robert Goldman, same thing. Stock attended by so just put it on the cards at the time. My staff principal so you play this out. And then the lightning round is over. Are you ready? Ski Daddy. Tell me the lightning round. How about we start with Joe in New Jersey? Joe.
Hello, Mr. Kramer.
Joe, man, how you been?
Okay, doing a little bit of fishing, but no luck with those stripers on the surf.
I've been reading your book later, but oh, thank you, buddy. Book reader.
Yeah.
How can I help you?
Okay, with Stifel increasing their price target on Mettler Toledo International, is it a buy down here?
You know, this is a very poorly covered company that happens to be a very good company. I always have felt that people should be focused on it, but they're very not promotional. You got a good one there. All right, let's go to John in New Jersey. John.
Jimbo, how you doing today, buddy?
Couldn't be better. How about you?
Dude, if it's not one thing, it's another. Jimbo, you and your book are so hot right now. If they come near you, they'll get third-degree burns. Jimbo.
Oh, my. Yeah.
We have rate cuts on the horizon. We have a housing affordability crisis and short of homes. We, the Open Army, spearheaded by Eric Jackson and Anthony Pomp, believe in Canada Kazan team. You want a CEO putting his time and money where it needs to be. I believe this stock will continue to run upwards, just like your is running off the shelf. Jimbo, right. I'm always a gentleman who opens the door. Give me some extra juice on Open Door Technologies.
Well, you know what, John? Here's the problem. This stock is high given the fact that the company makes no money. I'm not a believer until it makes money. That's just how I am. I love your enthusiasm, but it's not making money. I need to go to Bill in North Carolina. Bill.
Booyah, Jim, from 336. Appreciate your show and everything that you do.
Thank you.
Learn a lot.
Thank you.
Still needing to try to learn a lot more. I bought Poet Technologies as a speculative stock.
It's losing too much money. It's losing too much money, and we're not. Remember, the era of magical investing is over, so I can't recommend the stock. Let's go to Trey in Minnesota. Trey.
Hey, Jim. Biohaven stock is down 75% year to date, but the CEO and other insiders just voted $33 million in the last week. You know their migraine success better than anyone. Is now the time to follow the insiders, or was that drug a one and done?
Okay, well, I'll tell you, in full disclosure, I have a deal with Biohaven over a drug that I've invented with the doctor, so I will tell you the stock seems very low to me, but then again, because I do have that deal, you might just say, well, wait a second, Kramer's, you know, how can you tell, but boy, is it low. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, to close out the week, Cramer's helping you make sense of this week's wild market swings and giving you tips on how to make long-term money in any market. Next.
How did I know we'd bottom only after we shook off the initial rally this morning? How did I know to tell you to be ready to buy when the time was right, like I did last night after yesterday's brutal session? Permit me my hubris, just for one day, because it's educational hubris. It's all about how to spot a bottom. It all starts with something called the S&P Oscillator. It's a proprietary measure of buying and selling pressure put out each night after the close of the market by a company called Market Edge. Last night at 4:18 p.m., I got the email, minus 3.73 on the oscillator. Now, the oscillator measures extremes. 0 is equilibrium, tells you nothing. Plus 5 means too much exuberance. You got to trim some positions. Plus 10 means like sell everything but your core holdings. That's rarity, though. Same thing on the way down. Minus 5 is when you have to start buying because we're oversold and due for a rebound. So when I saw it was minus 3.73, close to minus 5, but not there, I knew that whatever bounce we get at the opening would be wrong. Not enough selling pressure. But after the following swoon that I predicted, you get your chance. I've subscribed to this oscillator since 1987. So I've been wrong about half a dozen times today. Pretty good record. Now, before you leave the office, when everything's fresh in your mind, like I did last night, I like to go over what are the most important positions. The tells, I call them. The tells are named after the late, great Ricky Jay, who taught me how to spot what might be in the other guy's hand. A tell that the person might do. Google. He was incredibly special. Yesterday, after everyone thought the only tell matter was NVIDIA, right? When it turned down, they thought it was the end. That was wrong. What actually let us down yesterday were the stocks of Micron and SanDisk, two plain vanilla tech storage plays that had been red hot but suddenly turned ice cold. They plummeted. And then, and only then, did NVIDIA give up the ghost. So I knew to watch the action in those two as a prelude to any rally. They had to bottom and start going up. Next was Bitcoin. It had been in free fall. It needed to find a bottom and then do a U-turn, or there could be no hope whatsoever. Instead, it kept falling. And we need to see a combination of soft goods and drug stocks rallying, as well as the transports, especially the rails.
All aboard!
You get that combination, you got a kind of nice Goldilocks moment. Now, here's the tough part. Because we have so much round-the-clock trading these days, you can't wait for the market to open. You got to get up real early to see how important the tells are trading, okay? You set the alarm for 3:15 a.m., and first you watch Bitcoin. That thing trades like mad overnight. The most important tech stocks and the overnight average, they all trading. Sure enough, when I woke up, it was real ugly. That was perfect, because I could presume that it would be at minus 5 when the oscillator was safe to buy. NVIDIA was down 4. Bitcoin nearly hit 80,000. Perfect. Everything red. That freaks people out and results in what we call a crescendo bottom, where everyone throws in the towel at once, and then it's time to buy. I came to the office this morning, and it was all systems go, real negative, perfect. But then a big shot, John Williams, the head of the New York Fed, gives this speech where he basically says that a rate cut seems like it's an inevitability. Market takes off after that because hopes had just been dashed the day before on a strong employment report that we would get a rate cut. Well, that's no good. I knew we were in a jam, no crescendo. So I said on Squawk on the Street that you couldn't buy that opening. You had to wait for a reversal. Not enough to spare, especially when it comes to NVIDIA. But I knew that once Micron and SanDisk, the two that had let us down yesterday, went lower and then reversed, well, then I knew we'd be home free. That's what let us down yesterday, not NVIDIA. The crescendo was happening right in front of me. Then, when NVIDIA started printing higher highs and higher lows after a horrendous opening, it was a run for the roses. At that point, the big selling crescendo had been reached. A calm rally began. The action said it all. You have to understand, stocks do speak. They do say things. And if you listen long enough, you can spot a bottom like this coming. You could tell that the rest of the market was okay because the transports led by the truckers and the mighty Union Pacific and the soft goods powered by Johnson & Johnson and Procter & Gamble took off from the get-go, never looked back. Only to be joined by American Express, which is the best financial tell for positivity. Now, next thing you know, with the crescendo put in, Bitcoin rallies from the abyss, and then even NVIDIA stock goes higher. And you know what? That's all she wrote for the session. Now, I know this sounds like hocus pocus, but this is what I did for a living in my hedge fund for years and years and years. I picked bottoms and tops. I even wrote about it in a book called Real Money. So I had the tells. I had the cards. I heard the thunder of the herd, and I nailed it. Maybe it sounds crazy when I say stocks talk to me, but they do. Maybe after all these years, they just like me. I think it's good to have friends in high places. I like to say there's always a bull market somewhere. I promise everybody, just for you right here on Mad Money, I'm Jim Cramer. See you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.